Welcome to the SNN Network Canada virtual event. I'm your host, Robert Kraft, and on behalf of SNN Network and our lead sponsor, Small Cap Discoveries, I'd like to thank you all for joining us over these next 3 days. We're really excited for the lineup that we have ahead of you, not only our keynotes and educational panels, but also the presenting companies that will be showcasing their businesses on December 8th and 9th. So I'd like to thank all of our sponsors. I'd like to thank all of you for registering, participating, engaging with all of the content that we have to showcase for you, as well as in one-on-one meetings. So with that, I'd like to introduce our first keynote presentation of the day. This is titled Cheapies with a Chance, and is from our lead sponsor, Small Cap Discoveries, hosts Paul Andriola and Trevor Cherweek. With that, boys, take it away.
Great. Thank you so much, Bobby. Great to be here. My name is Paul Andriola. I'm here with my partner, Trevor Cherweek, and we're here with Small Cap Discoveries. And as Bobby had mentioned, we focus on the Canadian markets. We really operate in what we call the shallow end of the pool, the micro caps, nano caps, and the real small stuff out there. And we've been doing this for years. And what we wanted to bring to you guys today is something we call Cheapies with a Chance. Now, this is something that we've been doing for a number of years. What we do is we screen all the Canadian listed companies and look for companies that are extremely tiny, hence the cheapies. These are companies that meet a certain criteria we look for and are quite small and sort of undiscovered. And we're going to get into why we like this, why we think it's important, and why we think retail investors have a really sort of outsized chance of overperforming by using some of the tools that we use here. So Trevor, I'll let you move us along here a little bit. So yeah, so what this really is a process for identifying multi-baggers. And if you know what a multi-bagger is, that's a company that has gone up in price multiple times. So what we like is this type of criteria has screened out some extremely well, big, strong performers over the last number of years. And the idea here really is, again, like I said, small nano cap companies that have the criteria or sort of underlying things needed to become a multi-bagger and outperform the market. So why do we do it? Well, we do it partly because we know it works. We've been doing it for years. We also think this is where we are, can be more competitive or able to outperform because of sort of the nature of the area we're operating in. We're not competing with sophisticated, large capital players. We're not dealing with institutional players. So we think there's an outsized chance of overperforming. We're going to get into what the process is shortly. It is really what we're talking about is a process to find companies and determine, how they are as far as valuation. And again, trying to increase our odds of significant returns. Who does this work best for? Well, we really think this works best for the smaller retail investor that has a smaller amount of capital to work with. Again, who it doesn't really work well for is anybody who's got a large amount of capital and they're trying to allocate large positions in these nano caps. That just doesn't work well for that. It also works well for people who understand these type of businesses and have a high degree of patience, because sometimes it takes a while for these to kick in. And then as far as performance, we're going to show you some of the results that we've seen over the last number of years. And the nice thing is that it's been extremely consistent. So this list usually is anywhere between 5 and 10 companies, and you'll see the performance if you even just averaged out by buying all of these companies. Maybe flip over to the next page, Trev. Okay, so yeah, I touched on a little bit of this. It's really a process for identifying these potential multi-baggers at a very, very early stage. In some cases, we're looking at companies as small, as $2 million in market cap. Usually, we look at as high as about $30 million in market cap. We've certainly gone higher than that, but usually somewhere in between that sort of 2 to 5 million to 30 million is our sweet spot. And really what we do is this list that we put together. We do it at least once a year. This year we've done it twice. The process we actually go through is we literally go and manually review every single publicly listed company in Canada and review their financial statements. And from that, we screen it down to a more reasonable number, and then we get a little bit more serious in terms of what we do to shrink it down to sort of the top 5 or top 10 names. And what we're doing is trying to find the new ideas, and ideally those quirky little companies that fall between the cracks of everybody else's due diligence. And most of these companies will not properly show up in any software screening programs. So we want to find these, because those ones that fall through the cracks are ideally the ones that are more likely to outperform. Next. Okay, so why do we do it? Well, like I said earlier, we do it because we've seen the performance, and we're trying to review as many companies, and the old phrase, we're turning over as many rocks as possible to find little gems. We also do it because it's a good process to sort of cull your existing portfolio. So one of the biggest sell criteria we have is when we find something that's actually better than something inside our portfolio. So part of that process is just constantly looking for something that's better. We find historically you can, if these are small companies, but your risk reward a lot of times is skewed to the upside. So, very little downside because of how cheap these things are, and significant upside if you're catching these long-term growers at an early stage. So we love the risk reward. And I mean, we love to do it because it keeps us sharp, it keeps us looking, it keeps us active. And like I said, it's constantly helping us cull our portfolio. The sell criteria, again, like what I just mentioned, we're looking for a reason to sell one of our lesser performers and try to substitute it with a better performer. And we use the analogy, it's like fielding a hockey team or a football team. You're constantly trying to put your best players on the ice or on the field, and constantly looking for something that's better allows you to do that. The returns and profit, I mean, this is now, we've been doing it for I've been doing it for close to 10 years, probably a little bit more than that. We've been tracking it now for about 5 or 6 years, a little bit more officially. It's a proven system over that time frame, very consistent track record. Again, we're going to show you some examples as we get a little further along, but we found a number of multi-baggers doing this, some including one of my biggest returning stocks, returned over 200 times the original purchase price. So these can be life-altering and life-changing investments if you find them early enough. Okay, so why don't we get right into the process? So really, some of the criteria we're looking for, the sort of the recipe for our stock selecting, is this is really based on a concept of growth and high growth. So we screen immediately. We're looking for companies that are generating at least 25% year over year per share growth in revenue. So, you got to watch for how many shares a company issues. It might be doing an acquisition or something like that and growing through an acquisition, and they're growing their shares outstanding. That is not the same as a company who is growing organically without issuing any shares. So we're leaning towards companies that are seeing a very high rate of growth on a per share basis. So we know historically over time, high growth companies are going to command a much higher multiple. So we're trying to find these companies that ultimately down the road, with time, are going to get those higher multiples that are necessary to get big win in share price. And then given microcap inefficiency, growth stocks attract more interest, and thus value can be realized. So the funds that eventually we hope to be selling our shares to, they're looking for these high growth companies. The challenge they have is if it's too small, they can't really do anything. So they're kind of waiting for the company to grow into a certain size, and then ideally, guys like us will be selling it to them at a higher valuation, a higher price. And of course, most companies, if they're not really growing, they turn into a bit of a value trap. So we're looking for companies that are not dying or sort of, falling into that value trap type of business. We're really looking for companies that are going to be able to excite the market because of their growth and command that higher valuation. And then this is a bit of a concept where you're buying high with the idea of selling much, much higher. So a lot of these companies will have started to move, their share prices start to move. You want to buy these things as they are sort of convincing the market that they're starting to deliver on fundamental growth. The other thing we look for, so we're not just looking for growth at any cost. We want to see there's profitability or near-term profitability. So one of our criteria is we want to see at least 2 back-to-back quarters of profit, or very significant trending towards profitability. So we'll overlook a company that's not quite profitable, but you can see maybe they're a SaaS business and they're adding customers. You can see that as they continue to add customers, that profitability will come. So we'll look at those sort of situations, but we favor companies that are clearly profitable, especially 2 quarters of profitability. We want businesses where you can see there's some form of repeatability. Again, a SaaS type of business, there's significant repeatability in there, but you can have a business where they've got customers that constantly come back and they're constantly buying. So there's a fair bit of repeatability there. That gives us, just more visibility in the likely outcome and future. Realize that, in Canada, less than 10% of listed companies actually make a profit. So right there, we're looking, we've sort of gotten rid of 90% of the companies, and now we're focusing on that 10% that are showing a profit. And of course, we're going to try to weed it down to a significantly smaller number than just 10%. And we're also looking for companies that do not dilute. So if you're a profitable company, your what's called financing risk is less likely. So if you're a profitable company, you're less likely to dilute and dilute somebody's share position down to a smaller amount. So those companies historically tend to outperform over time. So again, profitability is the key thing we're looking for. And then as far as size, $30 million market cap, like I said earlier, traditionally we see a lot of companies that fit our list are going to be less than $30 million. It's extremely inefficient pricing, sort of priced market down there. Again, institutions, analysts, sophisticated investors, these market caps are too small for most of these individuals and these groups. So hence, there's a lot of sort of quasi-amateurs that are sort of fighting over the pricing of these things, and we think that's a very opportune market for those that are willing to do the work. Like I said, institutions can't come down here because they just have too much money to allocate, and they can't really buy a significant enough position to make it worth their while. Supply and demand, most of these companies are relatively illiquid, so any kind of increase in demand can have pretty a significant impact on volatility. And ideally, if things are going well and the demand is outstripping the supply, you can see a very, very sharp move to the upside. Tight share structure, that's something we're looking for. We want to see, ideally less than 25-30 million shares outstanding. And it's all a function of supply and demand. The tighter the structure, the more demand that comes into the stock, and the easier the stock's can move. And then we also look for things like, dilution. What kind of dilution is in place? Anything over 10% in terms of total stocks, options, and warrants. It gives us a little bit of cause for concern. It's not a major red flag, but we want to see that somewhat limited supply in the event that our stock is starting to fundamentally really start to perform. All this information we gather from CDAR. So I'd say the bulk of that information is coming from CDAR. For those of you in the US, you guys have EDGAR. CDAR is a filing system up in Canada. It's a very clunky, old, sort of very hard to use system. We love that fact because it prevents a lot of people who are not willing to do the work and uncover those rocks that we're constantly flipping over to find. So a lot of inefficiency for a lot of different reasons. We love that. Yeah, so share structure, like I said, we look for companies that have predominantly less than 25-30 million shares outstanding, but we want to see insiders having a vested interest in the business. So we look for ideally over 10% ownership by the management of the company. We also want to see directors have a meaningful stake in the business as well. So we're looking for that insider ownership. We've seen as high as 50 or 60% insider ownership. Bigger the vested interests, clearly, the more aligned they are with shareholders. The other thing we look for is, and we ask ourselves, how discovered is the company? That's actually why we called ourselves small cap discoveries. We're trying to find companies that are, not known by the investment public, or sort of not properly discovered. Is the company being talked about on message boards? Is the company being mentioned on, on BNN or CNN or CNBC or any of these financial news outlets? Are any analysts covering it? Typically these really small companies, they just don't generate the fees necessary to get any analysts or investment bankers interested. So we want to see as little chatter about the company as possible. That gives us the belief that it's less discovered and then more mispriced. Discovery eventually will leave, or sort of lead the liquidity, and it'll lead to price discovery. So we want to be ahead of that. And in some cases, we are the discovery mechanism. So we find out about it a little bit, and then, we're telling other people as well, and it starts that discovery process. So those are the things we kind of look for. And then what we also want to watch out for are some, things we call red flags, or in this case, maybe even yellow flags. So we're looking for, we want to see that management isn't, overpaying themselves. So we want to look for high management compensation as a bit of red flag for us. Shares being issued for debt, shares for service transactions. We want to see that the company is really treating their shares like gold. That really is part of the reason why we see so much success in companies that have less than 30 million shares outstanding, is management are really treating those shares like any of the other resources it has, and wants to, use it wisely. So we look for these little odd things like, shares being issued for transactions as opposed to cash, or as opposed to not being issued. That's a bit of a red flag for us when we see those things. And then, does the board have the right incentive? I don't think enough emphasis is spent on really determining how, how valuable the board is, but we want to see that the boards are, they have a vested interest in watching out for us shareholders. And how are they being compensated for that? Is this a country club board? Are the board members all friends of the CEO, so they just let him do what he wants to do? Or are they there meaningfully acting on behalf of shareholders? We want to see that they have, they're entitled to options and things like that, but sometimes you want to see them actually compensated with cash, because that prevents them from needing to sort of sell shares to compensate themselves. So it really is important to spend some time to see how the board is made up and how they're getting compensated. All right, so who does this work best for? I mentioned earlier, this strategy really works really well for smaller investors, smaller retail investors that have, a little bit less capital to operate with. Some of these companies may not, literally may not trade for days, or trade a small amount of dollar value on a daily basis. If you're a large investor, you really can't, you can't really make it worth your while down here. But if you're a smaller investor, you have $5,000 or $10,000 to invest, you can really be to your advantage to be able to play with these sort of smaller liquid or sort of less liquid companies at this stage. So the retail investor definitely has an edge in this part of the market. Again, working with small amounts of capital, you can be a little bit more nimble and able to operate where bigger guys can't. And but it requires a degree of patience as well. And the other thing is you're really in a market where you're dealing with competing with a lot of other amateurs. And I don't want to, I'm not using that word as sort of degradation. It's the big guys who have all the tools and a lot of different, call it computing power. You're not dealing with those competitors. You're dealing with other people who have lesser tools, and in some cases, really don't understand what they're doing. So that's your competition. So it gives you a better advantage if you're willing to do the work. Now, why microcap, or why even nano caps? If you haven't done it already, I'm going to highly recommend you read a book called What Works on Wall Street by Jim O'Shaughnessy. You're going to find that they've taken data from the last 100 or plus years, and they've really categorized all the different segments of the market and different classes and things like that. And, over time, clearly the best performing class has been these illiquid, micro cap and nano cap stocks that have high growth and profitability or near profitability. They've significantly outperformed almost every other asset class, and that's why we operate in this market. And like I said, our experience has proven that data out as well. Fantastic mispricing here. You can find companies that are still trading single-digit PEs and growing at 30, 40, 50% a year. Very, very hard to do that in the bigger market. So that's why we love these nano caps and micro caps. And you're able to find significant long-term winners at a very, very early stage. Follow this type of criteria, and you'd be shocked at how often you're going to stumble onto companies that turn out to be, in some cases mid caps, in time, or in some cases even, larger caps. So, and then, size and liquidity, we've talked about it a number of times, but eventually if the company continues to grow, the institutional money is going to come, it's going to drive liquidity, it's going to drive, margin expansion and price earnings expansion and all the metric expansions. So it's just a function of time and the company continuing to execute in size. You're going to see the return and the liquidity is going to be there. Yeah, I'll say it one more time, but big money can't really come down market until the company has reached a certain critical mass, and then it's fireworks. So that's why we're here. Okay, so let's really start to tune into some of these things. So these are the kind of returns and some of the examples that we've seen here. This process has uncovered some life-changing investments. It certainly has for me. There's a name here that we brought up before, but this is ideally suited for small investors. We've had 38 companies that have been officially profiled. There's a number larger than that. We've had 4 companies out of the 38 that have turned into 10 baggers or more. One of the companies was acquired. If you took every single company every year and averaged it out, it's a significant positive average return over that time. And then one of the biggest best performing stocks of the last 20 years is a company called Expel Technologies. The same process would have found the stock back when it was around 10 or 15 cents, and it's gone as high as over $100 US. I'm no longer a shareholder. I was very early on, but I will disclose that I'm no longer a shareholder of Expel, but it was very, very good to me in the past. Again, okay, so here's the chart. So back in 2013, when I first discovered the stock was trading at less than 20 cents. And subsequent to that, it's turned into a 200 plus bagger, or gone up over 200 times in value. And we're looking at a stock now, I think as of today, it's trading around $65, but a significant winner. We discovered this stock using the process that we're talking about here. Another one that came up on our list was a company called Sangoma. I'm not a shareholder of this company, but in 2016, we found it at 29.5 cents. Now it has done I believe a 3-for-1 rollback, but still the stock is trading around the $22 to $24 area, multi-bagger coming off that list in 2016. Another one, I was a shareholder, no longer a shareholder here, but found this company at 6 cents in 2014, and has since gone up to as high as about $1.20, trading right now around 80, 85 cents. Like I said, was a shareholder, no longer a shareholder, but you can see the chart in terms of the kind of return you can see on this. And then here's a list of companies right now. This is our Cheapies with a Chance list, came out in 2016. I'll go through this and say that right now I'm not a shareholder of any of those companies, but you can see the average return over that time frame was 532%. So if you bought every single company on that list and held it till today, you saw a return of 532%, just literally by blindly buying the whole index or the whole list. 2019, so a little bit closer to where we are now. There's the list now of those companies. I own Spectra Products and Aurora Solar Technologies. But you can see as of 2019, had you blindly bought the whole list, you would have, to date, you'd returned 284%. but the portfolio was as high as 378% if that was the makeup of your portfolio from that time. And then recently, here's the list of companies. We put this out in early January. I am a shareholder of Aqueous. I'm a shareholder of Innovatech, Pioneering Technologies, Vigil Health. So a number of those companies, but had you blindly bought the whole portfolio in January, you'd be up 120%. And that's with the backdrop of a pretty ugly microcap market over the last year. And then we just came out with a second one this year. This is about 2 or 3 months ago. I am a shareholder of Fab Forms. I'm a shareholder of Innovatech, Vigil Health, and Beware Holdings. So a number of those companies. But had you bought this blindly about 3 months ago, we'd be up 26%. And again, in light of a pretty bad market that we've seen over the last little while. So those are the real world examples, the companies that we've found through this process. Maybe Trevor, just jump to the next slide. And that's it. That's kind of it as far as the process and some examples. Remind everybody this, clearly is not investment advice to buy or sell a security. But if you have any questions about the process, if you have any questions about how we sort of go through and find these companies, I welcome emails to myself. You can certainly find me or Trevor on Twitter. You can see our handles there, but reach out to us at paul@smallcapdiscoveries.com or Trevor at trevortroweek@gmail.com. We welcome your questions. We welcome any comments, and we certainly hope that you'll, consider this strategy. I think it'll help your performance, and it'll make you a sharper investor.
So Paul, I've got a quick question here. I mean, you're talking about, Canadian microcap marketplace right now, and you've talked about it being bad. Like, what's going on in Canada, or what's happening to the liquidity? And why is it a bad market right now?
So, Trevor, you know what we do. We one of the exercises we go through is we talk to a lot of institutional investors and try to find where they're positioning themselves and whether they're going, we call it up market or down market. And predominantly this year, we've seen a flight out of microcaps by a lot of the institutional money. And what it's done is it's taken liquidity with it. So as they go up market, we see microcaps go with, basically drop in liquidity and drop in share price. So for us, we think it's a phenomenal buyer's market. There's less competition. There's less of that strategic money that's down market. And as we saw last year, where the institutional money actually came down market in a significant way, we had one of the best years we ever saw. So I think most of the reason for the drop in sort of values in the microcap space are, it's a bit of a hangover from a phenomenal year last year. A lot of it is simply that liquidity has gone up market, and these stocks have really, suffered from the selling that these institutions do when they go on to leave the sector.
Paul, one other question for you. If you have any takeaways for retail investors or investors in general, how do we go about getting the conviction once we find one of these ideas to actually hold it for this extended period of time?
Yeah, that's a great question. And again, something, Trevor, we talk a lot about. Conviction is key if you're going to hold these multi-baggers. It's one thing to find it. It's, a lot harder to hold it, especially whether the company's performing and doing well, or the company might be lagging and not performing well. You have to really know what you own. You have to do the hard work to get out there and really understand what you own, what the culture of the management team are, what they're really trying to do. You have to look a little bit longer term. You certainly want to watch out for red flags and be concerned if you see something that is looking like it's going sideways. But you want to stay on top of your investments. You want to do the hard work and treat it like a business. Like if you were going to go out and buy a business, whether it's a hot dog stand or you're going to buy, a software company that's generating millions of dollars in revenue, you're going to go and treat it like it's your business. And if you took that attitude when you're buying a stock, I think you're going to look at it differently when there's a stumble or if the stock has gone up in price. You're just going to treat it differently if you think this is your business. So do the hard work. Get out there and understand what you own, and own it like it would be your business.
Paul, one more question just for fun. What's your favorite thing about microcap investing?
It's like constantly going and you're treasure hunting, right? You're constantly, you got your metal detector out there, you've got your microscope, and you're trying to find something that everybody else has missed. Like as I heard one investor that we both know once say, that the minute you get a 10-bagger or multi-bagger, it's like crack cocaine. You're addicted. All you need is one or two of these, and you can see how it's going to change your life. It's addicting. Find a multi-bagger, find a stock that goes up 5, 10, 20 times in value, and you're going to want to do it over and over again.
Awesome. Thanks, Paul.
So on that note, I want to thank Bobby once again for giving us the opportunity to speak today and giving us the opportunity to sponsor his conference. I know a number of the companies that are out there. I'm excited to talk to a lot of them, and hopeful that everybody has a fun time and learns a lot and gets as much value this conference as I do, and look forward to talking to as many of you as possible. So thank you, and we'll see you soon. Bye now.